Evening, everybody. Welcome to our latest live webinar. Tonight we're going to be focusing on all things super, with obviously the end of financial year coming up, with a lot of discussion around superannuation due to the early release measures that were introduced by the government to help those with in need of financial support during this obviously most unprecedented time that we're experiencing. We thought it would be prudent and timely to have a session around superannuation and why super is still a very valid part of anyone's retirement plan and income producing strategies and also investment strategies. Tonight, I'm glad to welcome Nigel Smith from Netwealth. Nigel's been with Netwealth for just on 13 years as part of their technical services team. Along Keith Chu. Basically, Nigel is responsible for the provision of technical and strategic information to advisors, accountants and other Netwealth clients, covering areas as diverse as SMSFs, superannuation, of course, pension planning, contribution management, Centrelink and estate planning. So Nigel has obviously is across all parts of the financial services landscape. Nigel's formal qualifications include a Bachelor of Commerce from Melbourne University, various certificates from the Securities Institute and the Australian Stock Exchange, and he's worked in banking, stockbroking, financial planning for obviously a few years, as we can see there. So I'd like to introduce Nigel to lead the conversation tonight. He's definitely going to cover a fair bit of content. He's going to do a bit of introduction about why super is an amazing structure for investing and obviously retirement planning, that it is only a tax construct, but obviously due to those concessional tax treatments provides an amazing opportunity for most everyday clients to utilise. We'll then go into contribution strategies and how some of the new rules will play out regarding planning around contributions, and talk about around obviously COVID-19 and the opportunities where we can utilise superannuation to our benefit, even though we might be experiencing obviously some downturn in asset valuations and whatnot. And then I'll close off with some key points for retirees. So without further ado, I'll bring Nigel in. We've got obviously very important disclaimers to be aware of. Information presented tonight is general in nature. Obviously, if it is of any benefit to you, it's important that you obviously make the time to discuss how we can implement these particular strategies in your case based on your personal circumstance. So it's always important to not act, but to get the right advice and education and make sure that we apply it correctly to your circumstance.
Okay, thanks for that, Sebastian, and good evening, ladies and gentlemen. Sebastian, what I was going to say, what a year 2020 has been. We started off with drought, we moved into massive bushfires, we then had floods, and we now have pestilence. It's positively biblical in nature this year so far, and but despite all of that, the year rolls on and we're approaching 30 June, as Sebastian noted. So we thought it timely to talk about the value of superannuation with particular focus on what is happening and possibly the opportunities and some of the dangers, things to avoid that have happened as a result of COVID-19. As Sebastian said, as he had showed his disclaimer, I have to do the same. These are very important, not just legally. But they highlight something which I will repeat, I'm sure, several times during the night, and that is that as good as some of these strategies sound, and as much as you may well say, wow, that applies to me, please understand how important it is to discuss these with Sebastian first, because by definition, the case studies and the examples that I'm using are there to illustrate a particular point. So, for example, when we're talking about contributions, there can be a massive difference created by just one day. The difference between, say, 30 June and 1 July, as we will see, can be the difference between deductions being allowable and deductions being disallowable. It's the same with some of the capital loss strategies. Again, the case study is set to show what can be achieved with the strategy. For one person, it might save $1,000 tax. For another person, it may save $10,000 tax. Whether it's $1,000 or $10,000, the strategy is still very, very valid. But whether it's particularly valid to you as an individual is really what you need to discuss with Sebastian. And that's really one of the major key points that I think these disclaimer clauses need to, that's the key point to carry away from them. Okay, I'm not going to read it all out. I've left it up there for a little while so you can all read it. So let's get going. As Sebastian said, I'm going to do a quick overview of superannuation, then look at contribution opportunities, and then super pension opportunities, and then what I call turning some current negatives into future positives. When you're learning to do, or when you're doing training sessions, what they tell you about PowerPoint is you tell people what it is you're going to tell them. Then you tell them what it is you want to tell them, and then you tell them what it is you just told them, and hopefully having done it 3 times, some of the important points will remember. So that's what we intend doing. There we go. We'll start off with this particular slide. 30 years in Australian superannuation, and yep, that's probably going to be a bit difficult to read, and that's okay. Don't really expect you to read all of it. Really, the purpose of this slide is to highlight just how complex superannuation can be. So if I move my cursor over to here, I understand you can't read that, but this is back in 1992, and that's when Super Guarantee was actually introduced. And they're talking about getting up to 9%, I think it was, by 2002. Well, you know, as you'd be aware, Super Guarantee is still with us. They're still changing it. They're still arguing about it 30 years later. And then we look at a lot of the changes that happened here in 2007. And then we look again at a lot of the changes that happened here in 2017 and more changes in 2018. These are not all the changes, by the way. These are just part of the changes, and we just tried to pick up on some of the major ones. And this is just super. When you start to introduce personal tax, retirement planning tax, estate planning, CGT, small business, Centrelink, aged care, and the whole raft of things that your advisor like Sebastian's has to cover. We're trying to just give some idea of the massive knowledge base that people like Sebastian have to need to keep up to date with, and why it's almost impossible for the man in the street to do it if you're not doing this every day of your life. I think the other interesting point is a number which you're not going to be able to see over here, but this is the value of total super assets in Australia. Probably what it really was at the end of 2019, and that number is showing just on $3 trillion. It's a massive, massive industry, and it's going to go a hell of a lot higher. But I think the interesting point about all this is, I don't know whether anybody's been keeping up with it, and if you're in the room, I'd say, would you like to hazard a guess at how much money has come out as a result of the COVID-19 early release? Because there was a lot of press about, oh, it's too much money coming out of the super industry and all that sort of stuff. Well, according to the Parliament subcommittee last week, and I'm just looking at my notes here, there'd been a massive amount of early release, which comes out at $11.5 billion to date. Now, 11.5 sounds like a big number, but against $3 trillion in super, it's an insignificant amount. So I think despite all the hype and all the gloom and doom about early release of super and all of those sort of things, you know, let's look at the facts here. And 11.5 billion has gone out of an industry that is controlling $3 trillion. So superannuation is certainly safe. It's here to stay. It's really growing, and it's a major part of anybody's portfolio that you need to keep up to date with and make the most of. Sebastian, I can see you and I, but I'm assuming that other people, this is not sort of disturbing the screens too much if I move things around. So we'll start off with what is super. And this was a slide which I put together, which probably highlights the grey hairs and the grey beard. Yes, I play Santa sometimes. That I have, because I was actually in stockbroking in '87 when the first crash came through. I've been through the tech boom, the tech crash, the unlisted properties, the GFC, and now this. And I always heard comments from people saying, super's just no good. I mean, you know what, it lost me money. I may as well take the money out and put it in the bank or put it under the mattress. I wouldn't have lost money then. Clearly shows I don't understand what super is. Super is not a product in its own right. It is a tax construct. That's all it is. It's a tax construct which holds your investments. Whether the investments perform well or not depends on their choice and how you manage them, not on the super itself. Very good example of that is just from myself. I bought ANZ shares, for example, when they're about the $30 mark a number of years ago. Thought they're oscillating between 30 and 35, 6% dividend return, fully franked. Whacked into my super fund. Sounds absolutely marvelous. Well, they've been down to $15. Did I sell them? No, I didn't. Maybe I should have done. So I'm showing a loss there. And I thought to myself, well, what I should have done, of course, is put a floor under those and said, sell them no matter what at $28. I didn't. Then it got to $25 and I thought, oh, well, I've still got the dividends. It got down to $15 and I thought, oh, well, I've still got the dividends there at 6%. Well, now they've halved as well, haven't they? So, you know, it happens to everybody. It wasn't super's fault. It was the fact that I maintained and decided to hold them for the longer term because I'm just as interested in the 3% dividends because it's better than I could get in the bank anyway. Moral of the story there is, you know, it is not super that produces the returns. It is the choice of the investments, how you manage them, keeping in touch with your advisor, doing your reviews and all those sort of things, and assessing your risk profile and putting rules in place to try and help you manage through uncertain times. Unless you're one of the Packer boys or Warren Buffett or something like that, where, you know, you've got so much money that you can afford to have interlinked companies, negative gearing, discretionary trusts feeding into discretionary trusts and all those sort of things. Super is without doubt about the best investment you're ever going to get. I mean, it's accessible and it's low cost. Name one other investment that gives you a tax deduction on the way in. Okay, it's $25,000, but you still get a tax deduction. No stamp duty, no other fees or anything along those lines. If you want more in, you can put non-concessional contributions in from after tax. And again, there's no government taxes, there's no fees, there's no stamp duties. Get the money in there. And when you're in there, you're only being taxed at 15% at the maximum, which is a hell of a lot better than if it was in your own name. Realised capital gains after 12 months are only at 10% versus at your own marginal tax rate. And then when you come to the retirement, all the earnings on the fund are actually tax-free. And not only that, you can start pulling it out as a pension and pay no tax. There simply is no other investment around that is open to the man in the street, the normal PAYG, wage earner and things like that, that is as good as super. So having said that, we're going to be now looking at some of the contribution opportunities. There's not a lot here, and really because we've got so much to get through in many ways, and not necessarily an awful lot of time, what I'm going to try and do is give you sort of, if you like, a helicopter view of many of these things. And if nothing else, really what I would hope is that you're going to be taking a few notes maybe and say, oh, I need to talk to Sebastian about that sort of thing. So rather than going into too much detail about a lot of these things, it's really highlighting them so that you can decide whether they're pertinent to yourself and then go and do some more exploring. So this is a good case in point here. We're talking about non-concessional contributions or contributions from after tax. The rules haven't really changed. It's still, since 1 July 17, so that's a few years ago now, still $100,000 that you can get in there. Maybe up to $300,000 under the bring forward rule if you were 64 on 1 July of the financial year and meet a few other conditions. What you do need to be aware of, and particularly this year, is that the ability to get contributions into non-concessional contributions, rather after-tax contributions into super, is dependent upon your total super balance as at the previous 30 June being less than 1.6 mil. The key words there are as at the previous 30 June. And as you can see on the slide here, what that means is that we have some implications for the COVID-19 situation and the market drops that we've seen now. So if you're sitting there in your lounge room now thinking, oh, that's right, I've got some spare money, I can put it in, and I know we're talking about 1.6 mil. Key number, the key words there, previous 30 June. So for contributions up to 30 June 2020, you're not looking at your balance today. You're looking at your balance as at 30 June 2019. And that's not going to show the dip in the market value that's happened because of COVID-19. So if you were up around about that 1.6 million and you were trying to get money in, you're probably not going to be able to. But move from one day, from 30 June 2020 to 1 July 2020, and which date are we looking at then for your total super balance? We're then looking at 30 June 2020, because as at 1 July, the previous 30 June is one day before. That will reflect the drop in markets. And if your balance has dropped from, say, 1.7 down to 1.4 or something along those lines, guess what? Suddenly you can get contributions in as at 1 July that you couldn't get in as at 30 June. So again, very, very important to understand the importance of dates and the difference that one day can make. And if you're thinking, wow, that sounds good to me, again, I know I'm being boring, talk to Sebastian first about it, because it's incredibly important to get the timing on these things right. And this is a perfect example of where a negative, that is the drop in investment market valuations, can actually be turned into a bit of a positive as of 1 July going forward. Why would you get more money into super? What did we just talk about? It's a tax construct. Much, much better to get your money into super, deal with future capital gains, because I think we're all pretty confident the market's going to come back. Would you rather deal with a capital gain in your own name at your marginal tax rate, or in your super fund where you've got a much better tax options to deal with those sort of things? I'll have a quick look also now at concessional contributions, which are those tax deductible contributions. Again, things haven't really changed here. You can still get up to $25,000 per annum in as a tax deduction. What we're really talking about here most commonly is salary sacrifice and personal deductible contributions. And I probably should have put in their salary super guarantee, the SGE contributions. The point here, and again, where people get confused, is your total super balance, that 1.6 that we talked about in the previous slide, is totally irrelevant when making concessional contributions. You could have $5 million in your super balance and you could still make your $25,000 tax deductible contribution. So big difference there between your non-concessional and concessional contributions. There's no asset test limit on your concessional contributions and putting your $25,000 in. Now, the breaking news here is that the lower amount, the fact that it's limited to $25,000, has really been compensated for by the ability to carry forward unused amounts. And I call that breaking news because even though it's been in place since 1 July 2018, if you think about it, what you can carry forward is the unused amount. So as at 30 June 2019, you didn't have any unused amounts because that's when it was introduced. You can't have an unused amount in the year in which it was introduced. It's not until you get to the next financial year you can look back and say, what contributions did I put in that financial year ending 30 June 2019 that I did not use? So this really is the first year that we've been able to make use of the unused concessional contributions, and we'll be able to use them up to 5 years, 5 rolling years into the future. Now, again, there is a proviso on that. You've got to have a super balance that is less than 500,000. And guess when that's measured from? Again, is measured from when? The previous 30 June, or the 30 June of the previous financial year. Okay, so the strategic issue that arises as a result of, as at this financial year for the very first time, is this ability to start thinking, what didn't I use last year, and what do I want to use this year? or to put a strategy in place where you may have investment properties or portfolios or something on those lines that you know you're going to want to sell in 2 years, 3 years, 4 years, 5 years time, and it's going to give you a big capital gain. So let's be proactive here, and we can use these unused concessional contribution amounts. We can save them up over rolling 5-year periods to use them at a future date. So that works practically as we can see on this slide here. So what we're going to do here is we've got the previous financial year, the 18-19. We had a cap year of $25,000. We're going to assume this person put in $10,000, made a $10,000 concessional contribution. That leaves them an unused amount of $15,000. Couldn't use it in that year because it wasn't unused at that particular time. We move to this financial year. We're now talking 30 June as at 30 June 2020. So at the current time, $25,000 again is the amount. Let's assume they put in $10,000 again. They've got an unused amount now of $15,000. We had unused last year. We still haven't used this one this year. We now have $30,000 saved up, if you like, in our excess concessional contribution bank. Move to next year, it's 25 again. Something happened really good. You needed to have a tax deduction. You put in your full 25,000. You've used your full concessional contribution. So you've got no excess, but you haven't used any of the unused. So you still got your 30,000. Following year, 25,000 is your cap again. You only put in 5 because you put a big one in last year. You've got an unused of 20. You've now got $50,000 in your unused concessional contributions. Following year, you still got your 25. You sell an investment property. Maybe yourself and your spouse sell it for $300,000 profit, split that between the two of you, $150,000 each. You get a 50% discount on that. Guess what? You've got $75,000 worth of additional income in that year. Except, of course, you've got 50 here, you've got 25 here. You can make a deduction, a super deductible contribution of $75,000. You've used it all, and you start again in the next year. So a really good strategy if you've got investment properties in place or other investments that you're going to be selling at some future date, and you anticipate that you're going to get a really, you're going to have to deal with a capital gain at some future date. This is a good strategy to keep in mind and to start planning to get the best use of. Personal deductible contributions. So these are contributions for which you claim a deduction. Now, up until, from memory again, it was 1 July 2017, this just was not open or available to most employees. There was an old test around. I won't bother going through it in too much detail, but essentially it said that if more than 10% of your income was due to salaries or wages or earnings, then you couldn't make personal deductible contributions. That's all changed now. So even where your employer is making contributions on your behalf, or where you have a salary sacrifice arrangement in place, let's say you're doing that and you're putting in $15,000 a year via SG and salary sacrifice. If you had a spare $10,000 kicking around, you could put that in, make it up to the $25,000, and you could claim that $10,000 as a personal deductible contribution as well. It applies to all of these people that we're talking down here, salary wage earners. You can read all of those. You must obviously meet the work test once you turn 65, or you must meet the work test exemption in order to make any contributions into super. And we'll talk about those in a little bit more detail quite shortly. This whole area of personal deductible contributions is one which raises a lot of confusion and a lot of problems. And if I don't get, I reckon, 2 to 3 calls a month trying to solve problems here, I'll go here. And where the problem arises is around submitting this notice of intention to claim a deduction, what's called the 290-170 form. By default, any contribution into superannuation is a non-concessional contribution. In other words, there's no tax deduction on it, any personal contribution, until you put that notice in. And once you put that notice in, that's what converts it from a pre-tax, an after-tax contribution to a pre-tax contribution. The problem is, in order to get that tax deduction, the money must still be in the same fund and must be in the accumulation fund. If you put in your contribution, do not put in your notice, and then you roll it to an income stream or you roll it out to another fund and then you try and claim the tax deduction, can't do it. It's invalid because the fund no longer holds that contribution. So it's critically important that most cases when you make that contribution, that personal contribution into super, make the 290-170 form, the declaration, to turn it into a concessional contribution before you begin income streams, before you roll it over to another fund manager, do anything along those lines. The flip side of the coin is that you must have sufficient income in order to be able to claim that tax deduction. I know it sounds like a bit of an idiotic statement, but in the COVID-19 environment, what we are seeing is that as that last July, August, that sort of time, many people, particularly small business people, had a really good run up. They've been putting in their full amounts, their $25,000. Their accountant often had said, yep, you've got some spare cash, let's get that contribution made now. Put the form in, yep, we're going to claim the full amount, $25,000, let's get our tax deduction. What's happened now? We've got to now approaching 30 June, people are looking, putting in their tax returns. They've been hit by COVID-19. They've got losses. Suddenly they don't necessarily have the full $25,000 worth of income against which to claim that. So if your income has dropped and your super deductible contribution is in fact greater than the income, the tax office is going to disallow it. And of course, if the tax office disallows it, what happens? It just gets swept across into your non-concessional contributions. That's not too bad, unless of course you've maxed out your non-concessional contributions. And of course, let's not forget, if it's gone over into non-concessional contributions, you've still paid your 15% tax in the first place. So now you've paid 15% tax, the deduction's been disallowed, and it's gone into non-concessional when you didn't need to pay the 15%. So it's really important that you review these things, because if you find yourself in that situation, it is possible to vary that contribution to solve that problem. But again, only if the contribution is still in the fund, only if you realise this before you've rolled it over into another fund or into an income stream. And it must be done within a certain time frame. So there's lots of conditions around the ability to be able to vary that particular contribution in those situations. And I think in the last month, I think I've had 3 or 4 advisors ringing me saying, oh, this is a situation, how can we solve it? One was a fascinating one. It wasn't actually with an advisor, but a client had put in $325,000 to an industry fund, claimed the whole lot as a deductible contribution. So they paid 15% tax on $325,000. And of course, you just can't do that. Why the fund allowed it, we don't know, but trying to solve that one has been an absolute nightmare. So it is very, very important. Again, no, I'm repeating myself, talk to your advisor, talk to Sebastian before you do any of these sort of things. Okay, there are other opportunities to make contributions. These are the fairly normal ones, your spouse contributions, your government co-contributions. I'm not going to spend a lot of time on those. The details are there in front of you. The thresholds were increased last year, so now you can, if your spouse is making an income threshold of $37,000 through to $40,000, then it's possible to get a tax offset. The full offset is $540,000 at the 37 mark, and it reduces there until it's zero at $40,000. I put the formula there if you wanted to sort of see what it is. The breaking news there is that there are amendments currently before the Parliament. It's got through the lower house. We expect it will go through the Senate and be passed in June when they sit again. So it's not legislated yet. It's something you need to bear in mind. It should be legislated though before 30 June to allow spouse contributions out to age 74, whereas currently they're only available out to 69. So they're giving you effectively an extra 5 years to be able to do that. Once again, the normal work tests will need to be met in order to be able to do that, but it's an opportunity that wasn't there last year. Government co-contribution, again, I've got the details there. good one to get hold of. Let's face it, every dollar you can get into super, and if you can get the government to put it in on your behalf, let's go for it. Same with the low income super LISTO, the low income super tax offset. That replaced the low income super contribution. One and the same, different name. Government's playing politics basically, but at least it's still there. It's up to an adjusted taxable income of $37,000 or less. Once you hit $37,000, it's a sort of a sudden death sort of thing. You're not going to be eligible for LISTO. So it's good again for your low income people. There's no action required to generate that one. It's all done via your tax return, and LISTO would be paid directly to you via the ATO. The downsizer contribution is a good one, been around for a little while again, but once again, we get a lot of confusions about it. It's primarily from the proceeds of selling your principal home, and what we then get is, well, how about our holiday home? We live in that, and we rent it out, and can we sell that property, or we've got another property that we want to use? The answer is probably not, but the key is that the home you're selling must be eligible for either a partial or a full main residence CGT exemption. As you're probably all aware, if you sell your main home, your family home, your primary residence, it's free from CGT. But if, for example, you lived in a home for sort of 5 years or 6 years, and then you moved to a new one and you rented that one out for 10 or 15 years, and then you sold the original residence that has been part principal residence and part investment property, then effectively when you sell it, that capital gain is apportioned over the period that it was your principal or primary residence and that which it was an investment property. So that particular property is eligible for a partial main residence CGT exemption. And as it is partial, that actual property could qualify as well. So again, it's a matter of understanding what the rules are, because what you'll read in the newspapers and things is, oh, it applies to selling your principal home. Yeah, that's absolutely true. But the real definition is that the home which is sold must be eligible for either a partial or for a full main residence CGT exemption. Then the other rules, of course, you must own it for 10 years, contribute within 90 days, all those sort of things. The big thing is there with that one is there's no age limitation, not even 75. There's no work tests. It's right outside all your normal contribution caps. So it doesn't matter what your TSB is, doesn't matter how much money you put into super or any of those sort of things. It's outside all of those. So it's not actually going to count in your super balance until your total super balance until the following financial year. And of course, each member of a couple can contribute the 300,000, and it's really provided one of those members has lived in the property or owned the property for 10 years. It doesn't have to be both in order to get that. So again, that's a really good last ditch attempt to be able to make any contributions into super. Okay. We've talked about work tests and work test exemptions and all of those sort of things. Currently, in order to be able to make a contribution into super, as long as you're under 65, you don't need to meet any work tests. But once you hit 65, you turn 65, and that can be partway through the year. From 65 to 74, if you want to make contributions into super, you've got to meet the work test. And the work test is basically 40 hours in 30 consecutive days prior to making the contribution. So you can't put your contribution in once you've turned 65 on, say, 1 July and say, I am going to work 40 hours in 30 consecutive days, or I have a job and even though I've only been at work for 1 day, I will meet this test. No, you've got to meet the 40 hours in 30 consecutive days prior to making the contribution. Now, again, I know I'm sounding repetitive, really, really important to understand these rules. Let's just take a small example. There's a doctor who is normally retired, but he's on call. He's asked to be on call at a hospital from say, Friday morning until Sunday night because it's a long weekend. He never ever goes into the hospital. He's not called into the hospital at any point in time. He never sees a single patient. He stays at home the whole time. Would he meet the test? Chances are yes, he would, because being employed doesn't necessarily mean that you actually have to be there doing something. It can include people who hold themselves ready to be employed. And of course, you need some sort of reward because he was on call. He would have got some payment for that. But the mere fact that he didn't go into hospital, didn't treat anybody, does not mean that he was not employed. So again, if you're looking at these sort of situations, it's not always black and white, and it's really important to think outside the square a little bit, and to talk to Sebastian about what it is you've done, what you're trying to achieve, and just see how we can go around this. From 1 July 2019, so that was last year. I always get my years confused here. So it was this financial year, but it's actually last year. There is a work test exemption available. So this was brought in to allow older people to be able to get money into super as well. So for those aged 65 to 74, no work test is required in the financial year following the year that one meets the work test. There is a proviso that super balance is less than $300,000 in order to be able to achieve this. So again, it's there to help people get money into super at an older age where they maybe had lower balances because they weren't part of SG and all those sort of things. So it doesn't mean that it's only available at 66. It could be available for somebody who was working when they were 71, have now turned 72, couldn't get money into super. Well, they could now in the year following when they're 72. Why? Because it's available in the financial year which follows the year that one meets the work test. So if you met the work test last year, you can make use of this work test exemption in the following financial year. Again, one which doesn't get a lot of airplay, can be very, very useful in terms of getting money into super. And the breaking news there is that the same as for the spouse contribution, it's in the same piece of legislation from 1 July 2020, in other words, really month's time, month and 10 days or whatever it is time, the age at which the work test starts to apply is being extended out to include people aged 65 and 66. So up to age 67, if you like. Essentially what they're doing is trying to align the work test now with the age pension age. So that once this legislation passes, you'll be able to make contributions into super right through until you actually turn age 67. So it gives you 2 extra years, 65 and 66, to be able to make contributions without having to worry about the work test. And then you've still got the work test exemption, which will then kick in and give you the opportunity thereafter. And great news was that they included the carry forward rules with this piece of legislation. So that $300,000, the ability to make an additional $200,000 worth of contributions is extended now, or will be hopefully extended to those out to age 66 if the legislation passes. As I say, we do expect it to pass without too many problems. So there's a bit of a summary there. I need to watch my time a little bit. I won't go through too much of those, but there's a whole stack of strategic reasons now why you should still continue to put as much money into superannuation as you can. Get all the help from the government co-contributions that you can, and LISTO and all of those sort of things. Think about making the massive deductible contributions. Think about your unused concessional contributions and the carry forwards and all of those sort of things. If you think about that unused concessional carry forward, if you carry it forward for the full 5 years, potentially you can get $125,000 tax deductible contribution, which is not to be sneezed at. Very briefly, not going into any detail at all, is there are very, very special circumstances around particular contributions or abilities or opportunities to make contributions, and that is with total and permanent disability payouts or permanent incapacity. They don't count against your contribution caps because they're already in super. If the policy is held in the super fund, it gets activated, it gets paid in. It's almost treated as earnings in the super fund, so it's not part of your contributions. But there are very special benefits. You can get the tax-free element increased if you do it the right way. You can get a 15% rebate on disability income streams from the super fund, but again, it needs to be handled properly. Similar with life insurance, but even more important, because you know, if your partner dies and the death benefit policy pays out into the super fund, if you don't handle it right, you can end up with what's called an untaxed element, and you could end up paying an extra 15% tax on the proceeds of the insurance policy. And you've got enough going on in your world. If your partner's died, you don't need to pay another 15% tax on by inadvertently creating an untaxed element. So again, if you've got those sort of things, really important to make sure you get some good advice around it. Small business owners, the small business CGT concessions are an absolute boon. Can allow you to get up to sort of, I think from memory, is about $1.425 million into super in one hit for the 15-year concession, and all sorts of things like that. Personal injury contributions, again, you know, this is where you had a car accident or an accident at work, and you know that you've been awarded $5 million. Had a situation where a client was holidaying in Switzerland, fell out of an aeroplane, believe it or not, became a quadriplegic, was awarded $3.5 million from a Swiss court. We were able to get that transferred from Switzerland, bring it into Australia, get it into superannuation, the whole $3.5 million without having to worry about caps or anything else. So again, some really good strategies to help people in those very difficult times. All I really need you to be aware of is that, you know, there are good strategies there to help you there. So having looked at contributions, we're now going to look at super pension opportunities. So moving into pension phase, not a lot has changed in the amount that you can put into super, but there are some implications from the COVID-19, what's happened to the account balances. So you can still get up to $1.6 million in pension phase and have zero tax on the earnings. Now again, always remember, tax is at two levels in super. There's the tax which is paid by the trustees on the earnings, and then there is tax paid by the individual on the benefits which are paid out. So when we're in pension phase and you're 60 or over, and you've got up to $1.6 million there in your super fund, there's no tax on the earnings. The pensions which come out, including lump sums in actual fact, all come out tax-free. So again, all that remains the same. You still have to withdraw the minimum pensions. And as we'll see shortly, they have been reduced, but we'll talk about that one in a moment. Any amount in excess of that 1.6 can be left in accumulation, or it can be withdrawn. In accumulation is still taxed as just a normal super fund at 15%, which is a lot better than normally your personal tax rate. One of the areas I want to really look at though is understanding what happens to your member account balance versus what happens to your transfer balance cap, this 1.6 million. And it's the cap which governs what you can keep in there, can't keep in there, whether it's taxable, not taxable, whether you can get more money in, and all of those sort of things. So changes in investment earnings, positive or negative in pension phase, will not impact on your transfer balance cap of 1.6 mil. So if we take that to an extreme, you've got 1.6 million in there, you have great investment performance and it goes to 2 million. Your member account's at 2 mil, your transfer balance is still at 1.6. You don't have to take the money out. Converse, you got 1.6, just when in COVID-19, it's worth 1.4. Your member balance is 1.4, but your transfer balance cap is still 1.6. You can't get any additional money into pension phase because you're still at your 1.6 cap, even though your member balance may have dropped. So there's this interplay between what impacts on your transfer balance cap. So pension payments, for example, do not reduce the account balance for the 1.6 cap purposes. So in this situation, even if you've got 1.6 in there, you had no earnings at all, and you've taken out, let's say $200,000, because you've got to take out a minimum of 80, and you wanted to help the kids, and you went on a holiday, so you took another 120 out, 200,000, your member balance with no earnings is now 1.4. transfer balance cap is still at 1.6. If on the other hand, what you had done is say, I'll take my minimum of $80,000 and the other 120 I'm going to take as a commutation. A commutation of the pension payment. That is where you say to the trustee, I've taken my minimum pension. I want to take this 120 as a lump sum payment, not as a pension payment. That's called a commutation. And as long as you take your minimum pension amount, you can take anything in excess of that as a commutation. A commutation does reduce your account balance and it reduces your transfer balance cap. So with that example about 200,000, no earnings, 80,000 wouldn't adjust it, 120 would. So your transfer balance cap would come down from 1.6, better get the maths right here, hadn't I, to 1.48. That's created cap space. If you've got cap space, you can then move more money into pension phase, start another pension, roll back, do all those sort of things, talk to Sebastian about how you do that. But if you've got money in accumulation, you've got big capital gains there, that ability to move those assets, to create the cap space and move those assets in there is really quite powerful. So again, just as a general rule, whether you're at the 1.6 or you're not at the 1.6, because you never know what's going to happen in the future, take your minimum pension. Anything above that, take it as a lump sum. Okay, very, very important strategic points to understand and realise. The breaking news, of course, that everybody's talking about is that the pension minimums have been reduced by 50% for the 2019-20 and also for next financial year, the 2020-21 financial years. Very similar to what happened in the GFC. In fact, they just reactivated those old rules. So the account-based pension minimums have been halved. So have the market-linked income streams or the term allocated pensions, they've been halved. Always remember though, that it is the minimums which have been halved, the maximums have not been changed. Also remember that if you've got a defined benefit pension, from the Defence Force or from ComSuper or from some of the state governments and things, those defined benefit pensions where you can't get hold of a lump sum, but you can get hold of a lifetime income stream, doesn't apply to those. They're just going to continue on normally. The other thing to remember as well is that this didn't come out until really quite recently. And many people would probably have taken more already than the 50% minimum, which is now the requirement. That's fine. You can stop taking any more now. If you've taken, say, 60%, you just cut that off and not have to take any more. What you can't do is put that amount above the 50% back into the fund. If you've gone over your 50%, stop it, but you can't put it back. And as I said earlier, there's no change to the minimums. So here's just a little table which sort of goes through what's happened with those minimums there. We can sort of see there at age 65, it's normally 4%. That in fact now has come down to 2%, and you can work those numbers all the way through. The market linked area is a little more complex because the minimum pension in your market linked income streams is based on the remaining term. So the way you calculate that has not changed. But with a market linked income stream, under normal rules, the minimum is 90% of whatever that calculated amount is, and the maximum amount is 110%. So again, that means that the minimum in your market linked income streams has dropped from 90% to 45%. Again, a bit of confusion around that one. I thought you said 50%, now you're saying 45%. Well, it is in fact 50% of 90%, which is your 45%. Maximum hasn't changed, still up there at 110%. Transition to retirement income streams. Again, quite a bit of misinformation around these. They're still a very good strategy. What happened with them is that they changed the rules to say that if the TTR, the transition to retirement pension or retirement income stream, is not in retirement phase, that is, you start at a TTR as you start to wind down, so you're still working, but you want to put a TTR in place and turbocharge your contributions, all sorts of strategies around that, then the earnings in that TTR are going to be taxed as though they were in accumulation. It wasn't until the member running the TTR moved into retirement phase, that the earnings in the fund then became tax-free. Where this caught a lot of people out was where they became a reversionary beneficiary to a TTR and they hadn't retired themselves. So you may have had a situation, where one of the spouses was 67 and retired, or even 65 and retired, 64 and retired, and the other spouse was 58, 59. They die while they're in TTR, goes to the reversionary spouse. They're younger, got a real problem because they're not in retirement phase and you can't have the TTR and all sorts of things. So they changed the rules there, and that tax exemption is now available in TTRs where the TTR member is in retirement phase. That is where they retire, reach 65, or are a reversionary death beneficiary of that. There's a few more rules around that. It is quite complex, but there is now the ability to have your TTR either tax exempt in terms of the earnings or not tax exempt if you're not in retirement phase. The tax on the benefits to the members have not changed. So you could be in a TTR that's not in retirement phase, in other words, you're still working, but once you turn 60, the TTR that you take out of that is tax-free in your hands. So the earnings are taxable at 15%, but the benefit in your hands is still tax-free. So what that really means is that the TTR is alive and well for anybody who is 60 years of age or older, because you can still make the most of that tax arbitrage. So the strategy here, quite simply, is you're earning $100,000, you're paying your 39% tax or whatever the tax rate is that you happen to be on in that particular scenario. You've turned 60. Why don't you salary sacrifice $25,000 of your high tax income into super and take a TTR for $25,000 of tax-free pension? So you still have that ability to switch high tax salary for zero tax TTR pension from age 60 onwards. The earnings may still be being taxed at 15%, but your benefit is still coming out to you at 0%. So still a really, really big benefit in that TTR strategy. Without going into it as well, if you are still working up to the 65-year age group and you've still got insurances and things like that, can be some really big benefits to making sure that any life insurance policies and premiums and things are paid out of your TTR income stream rather than your accumulation income stream, because if you need to make use of them, it's often better to have it being paid into what is a pension fund rather than your accumulation fund. Way too complex and not enough time to go into that now, but if you're in that situation, big asterisks, talk to Sebastian about that one, making sure that your insurances are all structured in the most tax efficient way in the, I was going to say unlikely, but in the sad event that you actually need to make use of them. Okay, so summary on our pension planning. Strategic issues, reorganise your assets between accumulation and pension. Consider getting your high income, high growth assets into pension phase. Why? It's zero tax versus 15 in accumulation. Minimise your value in transferring assets. We'll talk about that one a bit more in the last couple of slides. Consider running down your accumulation account in preference to your pension account. Why? Again, accumulation can come out benefit tax-free once you're 60 and over, but the earnings are being taxed as opposed to taking it out, any extra amounts out of your pension where you're not paying any tax on them anyway. Consider your TTR strategy, but particularly appropriate from age 60. Okay, we're down to our last couple of slides, and I think this is a really interesting one, turning what I call current negatives into future positives. So obviously the big news is that lots of people's portfolios have gone down, just like my ANZ shares. Not all bad news, people, not all doom and gloom. The aim of this strategy is to minimise the tax on future realisation of assets in a post-COVID-19 environment. I think it's fairly safe to say that we may have gone down a slump. It's already come back about 20 or 25%. Markets will come back. We just don't know how long it's going to take, but they are going to come back. So at some future date, if you do nothing now and your share's gone from $30 down to $15 and goes back to $30 and you do nothing, you're still going to be facing the same CGT issues that you were facing before COVID-19 that you will face after COVID-19. So we've got this opportunity here where the prices have dropped back to maybe restructure our investments so that we can get ourselves a better tax outcome in the future. So what we're thinking about here is if you've got shares in your own name, particularly this would work, and you have the ability to make contributions into super, or the super fund has cash that can buy the shares, either could work as long as you get these shares into the super fund. You in specie contribute the shares or sell them into your super fund at the current depressed prices. And what that does is it minimises the CGT now, because when you in specie transfer from your name into super, that is a CGT event. What we achieve by that is we minimise CGT. We may even get some losses which we can use, but we move the assets into a tax advantage super environment for future realisation. So our assumptions here, the markets are going to return to the post-COVID-19 levels at some future date. We have investments in our own name, able to make contributions, and or the super fund has surplus cash available to buy them. I've set it at a personal tax rate of 39%. I could have set it at 47% in order to show it even better, but I thought most people are probably paying 39, so I've left it there. And I'm going to assume that all investments have been held for longer than 12 months. So this table really summarises, and I think this is probably the last slide. We'll just take a bit of time to go through it. So what's happened is at some date in the past, you've bought two shares, ABC and XYZ, both purchased for $20,000. Before COVID hit, so January, February, ABC had gone up to $60,000. That was a good one. XYZ had gone up to $30,000. That's not bad. Now we've hit COVID-19. ABC has dropped from from the 60 down to 25, and XYZ has dropped from 30 down to 5. So the current situation is that we have a $5,000 profit still on ABC, but we have a $15,000 loss on XYZ. So if we were to sell those now in the panic selling, or if we were to transfer those now into super, the cost base is going to change because it's a CGT event. So we would realise this gain of $5,000. We would realise this loss of $15,000. We'd pay no CGT because we can offset the gain against the loss, and we'd have a $10,000 loss to carry forward. Shares then return to pre-COVID prices, so $60,000 and $30,000. If we had done nothing, we hadn't sold them now, we just do what I've done with my ANZ and just say, yeah, they're just going to go all the way through. We would have bought them at 20,000, held them through the drop. We sell them at a future date at $60,000. We've got a $40,000 profit. Nothing's changed. Same with this. We held it through the drop. We followed it all the way down. We followed all the way back up. We don't sell it. Never get that loss. $30,000. We've got a $10,000 profit. 30,000 minus our 20. We've got a total profit of $50,000. What happens if we transfer them in specie into super or got the super fund to buy them? Firstly, they get realised here. So we realise that gain, we realise that loss, we pay no CGT at the point of transfer, and we have a $10,000 loss that we can use in the future. Or you might have other shares there and you might do this multiple times. Whatever. We haven't paid CGT, we have a loss we can carry forward. We've now got them in super. We sell them at the same time. It's gone back to $60,000. Our profit though is 35 because it's 60,000 minus our new cost base, which was 25,000. So 60,000 minus the 25,000 gives us a 35,000 profit. Same here. It's $30,000 minus our $5,000 current value gives us $25,000 profit. So we've got a $60,000 profit. We've increased our profit by 10,000. That's not a bad result in itself. What's better is what happens because we did that transfer into super, because super is this wonderful tax construct. If we had done nothing, and if our tax rate was 39%, we would have had our $50,000 profit, a lower $50,000 profit. You would have got a 50% discount, so $25,000 would be taxable. 25,000 at 39% gives you estimated tax of 9,750. If you put it into super and you're in accumulation, your tax rate is 10%, $6,000 on your $60,000 profit. There's no discount there. If you're in pension phase, zero tax rate, you've just saved yourself close on 10 grand in tax. That's not an example of a $40,000 portfolio. You can imagine what it could be if you had much bigger gains, losses, and things like that. Now, again, that's just an example. You really need, if you're in that sort of situation and you have those abilities, great strategy to talk to Sebastian about to see whether you can turn that negative, that current negative, into a future positive. So summing up, and I'm just a little bit over time, super is still good. It's a great tax environment. It's still really flexible. It's really safe. I mean, I know we say it's really regulated, it's highly complex, but really regulated makes it stable, makes it safe, makes it very reliable. Some things we haven't talked about is we haven't talked about estate planning. That could be another good session for you, Sebastian. But the key again comes down to this bottom one. Key is to get the good advice to make sure that we do turn these negatives into positives, that we don't by accident turn a positive into a negative. Thanks for listening to me. I hope you found it interesting, and happy to hand it over to you, Sebastian.
Thanks, Nigel. Great in-depth session there. Obviously a lot of detail in a lot of those slides where you know, for most, you know, general knowledge clients might have been lost a little bit, but that's the beauty about having someone like me on your side, and obviously the back and support of Netwealth and the team there of Nigel and Keith, to make sure that we can review all things in more detail with our clients and then hopefully provide the best outcomes. So Nigel, thank you very much for your time tonight. Appreciate your support as always. Thank you to everyone that's tuned in as well. I appreciate your support as always, and look forward to the next session. Have a good night. Take care. Bye-bye.